AMN Drive Time is sponsored by Aishin, your trusted and reliable source for aftermarket automotive components and technology. Visit AishinAftermarket.com for more information.
Simeon, welcome to AMN Drive Time, sponsored by our great friends at Aishin.
Thanks for having me.
Glad to have you. We are in beautiful Las Vegas for the Apex show, and we're glad you could make the time to join us today.
My pleasure.
So, Simeon, you've been at Morgan Stanley since 2014. Why don't you just walk us through, for the benefit of our audience, your career and how you came to Morgan Stanley and maybe where you were before then, and bring us up to speed.
Sure. So I'm an equity analyst.
Okay.
I like to joke that I'm a glorified commentator. I have to be an expert on a lot of end markets that touches the consumer. So I write research on about 35 companies. I call it big box retail, and I've had the privilege of following the auto aftermarket. And some of the prominent companies I cover or I do research on will be O'Reilly, AutoZone, Advance, etc. And in that process, we make forecasts on their financials, how much earnings will grow, how the industry grows, and in that, getting to know the supply chain, manufacturers of parts, private companies, buzz on everything. We have a view on electrification. So it's taking a holistic view and figuring out how quickly these companies will grow versus the other subset of consumer companies. And then we advise some of the most sophisticated investors in the world when to buy and sell these companies or these stocks.
Okay. And then how did you get your start? Were you just, one day I'm going to be a equity analyst? Where did you start and where were you? You've been at Morgan Stanley for 14 years. Where were you before, et cetera?
So I've been in finance or the financial services industry for about 24 years.
Okay.
I had this fantastical idea of getting into finance when I got to college. I didn't know what path I would take.
So people say finance. Finance can mean 100 different things, right?
Correct. And I was a overzealous young person who luckily got into human resource jobs as a summer, way too young, or initially in my maybe high school or college career while people were still having fun. And in those positions, I was able to explore the various positions within financial services so I could figure out what exactly the jobs were between investment banking, sales and trading, or equity research.
Okay.
So this idea of becoming an industry expert, of drilling deep to understand how companies work and then trying to forecast them, I said, oh, that should be interesting, holy grail. And so I pursued that in subsequent summers, and I've been in the business ever since. And we joke that if I were so good at stock picking, I'd already be on the investor side.
Well, you're probably pretty close to there already, right?
Potentially. I'm not that bad.
So you kind of touched on it, but the day-to-day life, we spoke another time, you said, listen, I live my life on an airplane. You live in San Diego, you were born and raised in greater New York, right? You live on an airplane, you travel. What's a typical day in the life or a week in the life of an equity analyst studying the automotive aftermarket?
It's a good way to describe it. I'm always on the run. It's very fluid. So let me just say this. There's 35 companies that we need to be an expert on. So that's in theory 35 corporate headquarters and places that management teams work.
Yep.
So making a rotation of visiting companies at their headquarters throughout a year. Then we have investor clients. Largest investors in the world are based across the world, not just the United States. In the US, the hubs would be.
So what would be an example of a large, sophisticated investor client?
So think about Fidelity, Wellington, T. Rowe. These are big mutual funds. Those are some of the institutional money, mutual funds. And then you have hedge funds, some of the largest multi-asset, multi-manager hedge funds in the world.
Sure.
Concentrated all over the world, but some prominent ones. So then to see the investors is one of the primary roles, to advise them. Plus you have to do the diligence on the companies. And then, to be a retail analyst, it would be in our best interest to be in stores and to kick the tires, no pun intended, I'm not that funny, but to kick the tires and see what's happening on the ground in every end market, not just singular. I happen to especially focus on the aftermarket. I've loved the aftermarket. There is a wealth of private companies that can make my diligence more meaningful and give us an edge. We're all trying to get an edge of how the industry is moving. And when you speak to investors, the more ingrained, the more sophisticated your research, the more that they're going to listen to you because they think and they hope that you know what you're talking about. And so that's the process. That's why this is endless, thirst for information. And we're constantly doing analysis using whatever data sources are out there, public data sets, talking to private companies, talking to suppliers, my time here at the show, getting a buzz from not just the public companies, but from the private companies.
Sure. Yeah. So the private companies, I think that's a good point for our audience too. You're just not talking to the public companies. The private companies are giving you good data, insights to what's going on in the marketplace.
Among the best. And it's a mosaic. It's that you can corroborate it with the conversations that you have with the public companies.
Sure.
And the questions that we're asking public company executives are made that much better and more informed. And then the quality of the answers end up becoming better as well. So you're trying to develop just a deeper understanding and then add value to your client's process and hopefully shape how some of the public companies are thinking, as we're looking across all the big retailers. So there's some best practice sharing that we can look across all retailers to have a dialogue so that the executives regard you or me as the analyst as a thought leader.
You would talk to manufacturers, you would talk to distribution. Would you talk to the installer, the mechanic level as well?
100%.
And would you go, you said you're kicking the tires, you're maybe going to a retailer's, an AutoZone or a store of some sort, but will you go and do a repair shop?
I would, and I have. We also have ways to get the tempo and heartbeat of that person, that installer, in a more scale manner. So we can run a survey of 50 or 100 installers, and we can we can locate that region. We can specialize a different group of installers. I love finding the owner of 20 of them, and then it's more bang for the buck.
Sure.
But exactly right. That is exactly the kicking tires that we do, and then we ask them, who are you buying from? How much business is to your number one distributor? Number two, what would it take you to change? How to think about these things.
Yeah.
All the nitty gritty, so that when we're asking the companies the questions, we're preloaded with most of these answers. We're just, kicking the tires again.
Sure. Let's talk tariffs. Are tariffs still new? So they're still becoming clearer, but it still seems like there's uncertainty related to that, right? So how do you see the aftermarket handling the challenges of product availability and pricing? These long-term things, I don't know. You're probably better at a 5-year thing. What do things look like in the next 6 to 12 months? Yeah. And are there any specific segments that you see as being most impacted one way or another about tariffs?
It's it's like a little tale of two cities, because the narrative that's getting described by the public companies is one of inventory availability is okay. We're not having trouble getting parts on the shelf, and we're raising price, and those prices are sticking.
Okay.
So it looks like a relative calm in a sea of a lot of uncertainty and disruption. On the other hand, the conversations I have from private, smaller companies, it doesn't paint such a pleasant picture. More struggles to get inventory, moving around vendors, relocating country of origin, and then thinking about price. There's a little bit of this game theory. Who moves first on what good, on what item. At this point, it sounds like everyone's moving as soon as they get the higher price that's handed to them. But there was a little bit of which categories do I move? How do I manage my portfolio? The big public companies, they have analytics, they have systems that help them manage this a little more sophisticated. So as far as their outlook goes, it's been relatively fine. They have all discussed managing to gross margin percentage, which means that if you're just taking price up and you're holding your gross margin, there should be a pretty decent flow through to the bottom line. And I think that's the beauty of the aftermarket. It's a mostly failure driven category. And so the customer at the end of the day, it's either deferral or you pay. There aren't many other choices. So that's all leading up into this outlook, which is we've probably seen about 50 to 60% of pricing from, call it tariff version 1 or 2. The summertime tariffs that got enacted, thinking about inventory turns plus when that starts entering into the product set, it's probably another 30 to 40% of pricing that's going to come. So far, the auto aftermarket demand has been fine. Now the next round of tariff is going to come with price increases, not just across auto parts. I'm looking at everything. So we're saying, what's the ability for the customer to spend? That could get impacted, but we're going to have more price that's going to push through. The public companies have hinted high single digits. Some of the private companies I've spoken to have talked about like low teens, low to even mid-teens. So there's more pricing. We don't know what we don't know about how the consumer will handle everything holistically, but we think the outlook's pretty good. And then in terms of that last question, which segments, it's, you know, the discretionary piece has been the one that's felt the impact so far. We're just beginning to see pullback or elasticity in discretionary. But if it's like a maintenance and repair or failure categories have been fine. There's no choice. There's been a little bit of trade down, meaning lower price points, but the discretionary piece is the one we're watching. That's the one that it feels like there's some deferral happening real time as we speak.
So I've been in the business, the aftermarket, for 40 years. And tell me if this is a true statement. Everybody's talked about it forever. The aftermarket, generally speaking, is recession-proof. Mm-hmm. So in downtimes in the economy, the aftermarket still does okay because people still got to drive the cars unless you live in New York or San Francisco or Boston, or they have public transportation. And then when the economy is good, it's even better. That's broad strokes. Is that accurate still in your mind?
I'm flattered you're asking me with 40 years to my 24.
You're an analyst. I'm just a media guy.
You nailed it, though. I mean, that's exactly right. And the data proves it out. So we call it acyclical, which means it really doesn't follow any cycle. But we know that when the customer has more money, especially DIY, the discretionary volumes pick back up. So think about stimulus that's coming next year. That could be a catalyst for seeing better spending. But you're exactly right. In the downturn, financial crisis, there was about a 6-month period in which every category of consumer spending suffered, including auto parts. And then after that, it was off to the races. The car park aged, got older, and then people had to take care of their cars longer, so on. We're entering like even that moment right now where the car park is, what, 12 to 13 years old, pushing 13. Yeah. But the way you described it is exactly right. The psychology of the investor, of the market, is that if consumer spending broadens out to more discretionary categories, that auto parts will lag. This always happens, and we're in that mindset as we speak. But it never plays out. Auto parts end up holding up as well as many of these other categories.
So when you say discretionary, just as an example for our audience, what would it be?
Yeah, so it would be home improvement spend, kitchen, bath updates. It would be furniture. It would be electronics.
Got it.
High ticket discretionary categories. So right now the consumers say, hey, I have to fix my car. I don't have a choice. Yep. So I have to defer some of those purchases. But hey, but we want to chase where the faster growth is. You would think you're going to sell a lot more TVs. You probably will. Yep. But auto parts, not going to slow.
You know, for years and years, it seems like private equity for a long time was not that interested in the aftermarket. But the last 20 or so, plus or minus, big interest by private equity, right?
Oh, yeah.
What was the spark? Just that the aftermarket's a steady, great business? Or what sparked that?
The spark is there's been consolidation consistently. So the big getting bigger, and you can look at the big retail. I call them the retailers, DIY, but you know, their biggest growth business is their distribution businesses. Sure. And if you were private equity, you could look at how fragmented the country is and how great businesses are across the country, right? There's some phenomenally run distributors across the country. So the idea is you roll them up, put them together, something bigger, and there's a natural exit strategy, whether it is to sell to a larger company or maybe have a chance at becoming public. So their consistency of growth, I like to say that the industry it's competitively benign. And why? Because most of these CEOs would tell you, okay, we can laugh at that. They'll tell you that.
I like the phrase, by the way.
It's questionable, but the reason why it's arguable is because you win the business on when a product fails and how quickly and is that product in stock, how quickly you can get them that part. So in that standpoint, and you're passing along the price to the consumer doing the repair.
Right.
So yeah, it's very steady. You tend not to be as volatile as economic cycles, to your question just earlier about growth rates. And then the gross margin, the markup, tends to be pretty stable. So they generate great cash flow. So, you know, there are logistics that need to get glued together. And then there's different regions that are interesting to others. But that's, to me, why private equity will stay interested in the space.
So as we mentioned, we're here in Vegas for the Apex show. It's November 3rd exactly. So this may be irrelevant by the time we go live with our conversation. But do you have any thoughts about First Brands? I've never seen an aftermarket business been in the Wall Street Journal so consistently as this First Brand situation.
Yeah, it is surprising. Although over 24 years, expect the unexpected, so nothing is that surprising. I've been asked about this company for the last 5-ish to 7 years.
5 to 7 years.
Roughly about their rapid ascent.
Oh.
The ascent and how quickly they put this group of brands together, and they're the ones to watch. And they still felt like they were under the radar in terms of what they ultimately wanted to be and what they wanted to look like. And yeah, I mean, I'm reading the headlines as you are. It seems like there's, more than meets the eye. I look at it as after the fact, what could happen as the downstream effect? Will the retailers and distributors have access to enough parts? The answer looks like yes. And of course, it's going to be in that company's best interest to sell whatever they have, whatever financial situation arises. And then two, are there any other financial ramifications from this? Advance addressed this on their last conference call. The idea, a lot of these big retailers, they have these big payables facility, right? They don't have to pay, they have a group of banks that are actually paying the bills, and it's based on the credit of the underlying retailers. And so there was a thought in the market that the cost of this credit, or the discount that these vendors effectively have to pay in order to do business with these companies, would go up to price in the increased risk in this financial system. It sounds like that won't be the case. And it does sound like this was an isolated incident to a company where, we'll find out the details, but a very idiosyncratic situation around how they finance this business. So, we'll see. But I don't think there's going to be, financial impacts to the retailers, and nor, in terms of their sourcing. So it looks like, it's an event. And by the way, the stocks are priced in risk for this. The market didn't know how to handicap this. These are one of these events where it's like, well, what else could happen here? But I think they're figuring out this is isolated to one set of brands, and, there's going to be enough availability of parts one way or the other.
So you're talking to everybody in the kind of chain of distribution, manufacturers through the installing marketplace. How do you see, just on a macro level, are companies addressing the aging car park and longer vehicle lifespans in terms of product and service strategies? So
if you look since 2019 till now, inventory per store has risen about 36%. You could push back and say, well, inflation's up about that much. It's up a little bit less, because even today, inventory per store for the companies I follow, I don't know the private information, it's growing mid-single digits. So aging car park, more makes, more models, more years, more parts complexity. Distribution centers are getting bigger, more hubs, more mega hubs. They're adding parts. Now, how do you source them? It's your bell curve. They're getting more sophisticated in figuring out what to carry and what vintage.
Right.
Couple of companies, and Advance Autos talked about using AI to help them catalog a little bit better, to use demand prediction. That, I think the big companies are going to start to distinguish themselves to better understand demand curves using whatever AI, big data that we've either had or we've been doing all along. Now we just call it AI. Those are some of the things that they're doing. And I think that continues. And the name of the game is more parts. There was once this concept that we needed to carry 80% in the store and we're okay, then we can use our hubs. That's not the game. I think if you look at the most successful growth rates, it's from the companies who had more parts closer to the consumer than ever before, not fewer. But they're getting smarter of how to tier it, like how many degrees away from the point of sale can it be? What's the tolerable amount of delivery time to get it there? And obviously, the older the car, the more specialized, there's a little bit more tolerance for that. But they're investing in parts. That's their biggest investment. They know what vintages, what vehicle park within their local market better than ever before. and they're sourcing to it. And the companies that do that the best are showing the most success.
We mentioned earlier, long-term crystal ball, tough stuff. I think maybe for an analyst, it's not so hard, but I'm not going to even say 5 years.
Yeah.
3 years, 36 months from now, we're sitting at Apex, we're talking in this room. What's the market looking like? Macro, just your broad strokes thoughts.
Yeah. So one of the things about being an analyst is that you live in history, and then we use history to look at the future. In this case, the history is so consistent, it's very fair to just, you can have a prediction that follows that path. And the biggest theme by far is consolidation. So over the last 20, 25 years, the big four, okay, and I'll take the big four as O'Reilly, AutoZone, Advance, and GPC, have gained about 10 points of collective share within the industry. It's about 26, 27%. It used to be around 15.
Okay.
So if you do the math you divide it, it's about 40, 50 basis points per year. And I will confidently make the prediction that that will continue, and arguably it should be at a faster rate. In 3 years, I will not say whether we'll have 4 or 3, but the likely path of the big four likely consolidates further in some form or another. It makes sense. This is the trajectory that we've been on. By the way, within that share puzzle, the dealers have had a very steady share. They're a piece of the aftermarket, as you know, at around 27, 28% of the market. It hasn't really moved. It's been a lot steadier than you think. So what's the variable? If the big four are getting bigger, the dealers are static, it's everyone else, including a lot of the private folks that we speak to, especially at this event. That's the piece that's shrinking. Everyone knows this, but that shrink, to me, continues at the same rate. Industry is still going to be growing. There's different car park complexions. I think we're going to have an older car fleet, go figure. Right now, we're not as worried about electrification once again, which is full circle, poetic justice, versus last decade, where we had a losing argument. But we probably will still be downplaying that effect. It won't take over the car park as much. Low to mid-single digit growth, more consolidation.
Do you see consolidation at the manufacturer level as well? Could you talk specifically about distribution?
Likely, but how do you not? So I struggle with this, and I've asked the companies for years. If the biggest companies that are growing the fastest are the ones propagating private label the fastest, the math is the math. We struggle with, we think about this idea on a tangent like private label in the grocery space. We cover Walmart and the likes. And if it's the companies that are growing the fastest are pushing it the hardest within their ecosystems, think about the way you buy your goods, then by math. So that should put pressure, looking at it from a bird's eye view, that will put pressure on the manufacturers to find synergies, AKA get together so that they can reduce the central cost, so that they can either negotiate better or have more leverage with the retailers.
Simeon, let's talk about autonomous vehicles. It seems to be getting a little more buzz recently. My son was just in an autonomous taxi the other day in San Francisco. He was visiting. Do you guys have a view on autonomous and what it means to the aftermarket? Are there less miles driven? Are there more miles driven? Is the underperformed maintenance being taken care of because the car is going to go automatically and get its brakes changed?
Right. It depends on which camp you're in. I don't have a strong view, but I'll paint both sides. In theory, right, your car is sitting on your driveway now or sitting at an airport somewhere. No one's using it. So why do we need 300, whatever number of 100 million of cars sitting around the US right now? So the idea is if it's autonomous, the utilization of the fleet goes way up. And the utilization goes up, we don't need as many cars. You can cut the fleet by almost 2/3, right? Because that's the simple math of how inefficient our car fleets are.
I don't think we like that answer.
Correct. But it's out there in a futuristic science fiction movie where cars just keep moving all day. Now, to your point, there are going to be maintenance needs. They might be more centrally done. Depends on who manages the fleet. So we're adding layers of complexity. These are out there things to think of. When we asked about near-term outlook, I wouldn't even think of these for 10 years. As a retail analyst, we think of how the retailers can do the last mile of delivery. And one of the biggest costs, it's the human and the vehicle to get to that person. That could be solved by autonomous. So there is an argument, there are some uses of autonomous here, like taxis in San Francisco. I personally don't think we're going to get taken over. There is a utility, as we learned in microeconomics, the utility of owning your own car, sitting on your own seat all the time and not having shared. But what vision of society do we have in 20, 30 years, and the values? I don't know, right? We don't know what that looks like. But that would be the draconian bear case, which is out there to contemplate, but it doesn't feel, it feels as foreign as like EVs taking over the world 15 years ago as it did, but it's something to think about.
So Simeon, we do something here, if you've seen drive times before, called lightning round.
Mm.
And I'm going to ask you some questions, and you're going to give me a quick answer off the top of your head.
Yeah.
You ready?
Let's
You
go.
seem like a sharp guy. I think you can handle this. We're going to find
Fire
out.
away.
We're going to find out.
Yeah.
If you could master any skill with a snap of a finger, what would it be?
Hitting the golf ball and changing my oil.
Wow. Okay. I don't know what's more complicated. I think hitting the golf ball might be more complicated.
The more I play, I'm not getting better. It's frustrating. But I also am embarrassed to say to this group, I've never changed my own oil before.
It's not so much anymore in this world, unfortunately.
Okay.
Number 2, what's one lesson from your early career, financial career, that's still relevant to you today and something you sort of never forget?
This is as a retail analyst, and this is more observational across the industry. It's the bigger getting bigger. So there have been moments of times where you look at mid-sized companies and there's always hope for value or small cap or revivals, and it just has never played out. You don't see smaller companies, retail turnarounds, let's put it that way. Retail turnarounds are few and far between. There's always an audience to get excited that there's a chance that can happen. And I think that plays on our psychology as humans.
Yeah.
But they're few and far between. It takes a lot of the right backdrop in industry for that to happen.
So this wasn't one of my questions, and I'm just thinking, is just an average investor out there, which many of our audience we are, buying the S&P 500, which is 500, I don't know if they're the biggest companies, I don't know exactly how they figure out. That's not a bad bet.
I'm not a financial advisor. I'm pleading the fifth here.
Understood.
I think it's been fine over time if you take a look.
Yeah. Okay. Number 3, what's a golf course on your bucket list?
Oh, Cyprus.
What's number 2?
Shinnecock.
Share a habit or a routine that's successful to you to make every day a good day.
To make every day, I'd like to work out in the morning. Always. Early. It stresses me out the longer the day goes if I haven't done it. But early morning, get it done, feel good, get something accomplished. Always.
Me too. And by the way, I don't know how long you've been here. I've been here two mornings so far. I've been in the gym at this hotel at 6, and there's nothing. The place is packed. Everybody's coming from the East Coast and feels the same way.
Ours opens at 5,
Yeah.
packed at 5.
Yeah. Craziness.
I know, every year, but I got in 4:50 because I knew about the rush at 5.
Smart. Okay, last one. Favorite thing about New York? I know you live in San Diego now, but you're sort of kind of a New Yorker, right?
I'm going to say food, but if you drill down, it's pizza. Now, I'm not on the New Haven pizza scene, but having been a New Yorker, like Pizza Bagel, it's not even being a snob, it's just being objective. And it's really that bad in San Diego, and it's a lot of, maybe, but it doesn't cut it. That's it. New York, I'd spend the time to go get the good pizza, and it's worth it. And the bagels. Both.
Simeon, great to have you on AMN
Thanks for
Drive
having me.
Time, sponsored by our friends at Aishin.
Thanks for having me. Appreciate it.